Hey, Moon Platoon, we have Alexis Alexis Goldstein. She is doing an AMA here on the subreddit rGME, right? She's giving her time. If you guys don't know who she is, well, let's open it up right here. She is a senior policy advisor. Here's a little bit about her, right? The House Financial Services Committee. She talked over here about the second hearing in GameStop. She started as a programmer in Morgan Stanley in electronic trading, and then was a business analyst for Merrill Lynch and Deutsche Bank in equity derivatives. So she has a wrinkly brain, and I want to give you guys a quick overview on exactly what she covered through this AMA so that you guys don't have to. There are big sweeping similarities in the ways that she's answered most of these questions. So I want to be able to say, here are the most important points that she wants you to know about. So first of all, she is a Python girl. So there we go. In programming languages, she's partial to Python. You can do so much with so little code. And she is a Linux or a Mac girl, but she needs to crunch things in Excel. It's nice to have access to a Windows machine. Could not agree more about that. Well, now for more important purposes, there are two big picture thoughts about what she thinks SEC should do in order to step in and answer questions. This was a question asked by Renzel. And she also has a feeling about exactly how much more data democratization, more data transparency these hedge funds should actually go into. So let's cover exactly her words verbatim. It is very difficult to truly understand what Citadel is. It's very difficult to truly understand what Citadel, the hedge funds' complete positions are. Remember, Citadel has multiple arms. That's why she has to be specific. That's due to the real lack of transparency in the reporting that hedge funds are required to do. Hedge funds managing $100 million or more of certain types of securities do have some reporting requirements. These happen quarterly through a form called the 13F. However, they only need to report certain kinds of securities, and they don't need to report stock short sales or short option positions. That makes it hard to know what fund is doing and what their net position is. If she thinks that there is transparency into hedge fund positions, that would be good for the market overall. And here's a recent letter that she wrote on the topic. She does think that regulators do need to be closely monitoring the repo markets, right, the repurchase markets, and seeing if there are places where reforms are needed. It has the potential to be a source of real risk to the financial system. If you want to read more about repo markets, we talked about it in extensive detail with A. Tobit, who came on the show yesterday in a surprise interview. He was the one that wrote the BlackRock bag holders, the Citadel has no clothes, and most importantly, the bombshell that mortgage-backed securities back in 2008 have just repackaged themselves as repurchase agreements, repos, and that is the everything short. If you guys have desire to learn a little bit more, we do have this article lined up for us to learn more about repo markets towards the end of the video. And hey, this is a good reminder, if you guys have not yet smashed that like button, please do so. Helps other Space Apes and Moon Platoon members find this video because it defeats the YouTube algorithm with us. And more importantly, smashing that subscribe, because we're on our way to 100K and we would like to have you with us. 100,000 subscribers for the win. So now on to what she thinks the SEC should be doing. In the short term, a lot of things can happen with the laws that we have through actions by the regulators. And this is parroting a lot of the sentiment that the Republican lawmakers had when they were asking questions about whether or not the SEC has the ability to actually start enforcing the rules that the Democrats want to be enforced. The SEC should consider changing reporting requirements on Form 13F to bring about more transparency. The Financial Stability Oversight Council is able to designate non-banks, be they hedge funds or asset managers or something else, as systemically important in order to bring about oversight regulation by the Fed to these entities. Senator Warren asked Treasury Secretary Janet Yellen about this in a recent hearing, regardless of the asset manager BlackRock. So here is a video clip of their exchange. Let's go check it out right now. And this is a quick 2-minute exchange between a senator and the head of the Treasury, Secretary of Treasury, Janet Yellen.
Companies, Bear Stearns and Lehman, but it isn't just banks that pose a risk to the economy. In 2008, 2 investment companies, Bear Stearns and Lehman Brothers, failed, triggering the 2008 crash. So when Congress passed Dodd-Frank, they created the Financial Stability Oversight Council, or FSOC, and gave it the power to designate non-bank firms as too big to fail, or in the terms of the statute, to designate them as systemically important, which means they get the same stronger oversight as the too big to fail banks. Is that right, Chair Powell?
Yes, it is.
Okay, so let's look at an example of how that's working today. BlackRock is the world's largest asset management firm, overseeing nearly $9 trillion in assets. That's more than double where it was 10 years ago. It also holds a stake in just about every company listed on the S&P 500. To put that in perspective, BlackRock manages more assets than the entire GDP of Japan, or Germany, or Great Britain, or any other nation in the world except the United States and China. And it's not just size. BlackRock also runs a technology platform that currently houses at least 10% of all the stocks and bonds around the world. So, Secretary Yellen, just hypothetically, if a $9 trillion investment company failed, would that likely have a significant impact on our economy?
Well, Senator Warren, I believe it's important to look very carefully at the risk posed by asset management industry, including BlackRock and other firms. And the FSOC began to do that, I believe, in 2016 and 2017. But the risks it focused on were ones having to do with open-end mutual funds that can experience massive withdrawals and be forced to sell off assets that could create fire sales.
Oh, okay. That scared me. I was like, whoa, the hedgies have gotten us. Well, that's the main point right now, is that can BlackRock actually exist, or should it exist, as a too important to fail a financial entity, even though it's not part of the federal government? So that is something that we have also covered live. So if you guys haven't turned on notifications yet, that is something that you will miss out next time it happens. So make sure that you have already. Let's see. Okay, so that is the main idea right here, that we have the Don't Fight the Vol, Alexis Goldstein, giver of her time to the Reddit community, doing a Ask Her Anything and talking about how the SEC should point out that there should be more data transparency in the 13Fs. They only update once a quarter. Let me see if I can find this. Yeah, well, they only update once a quarter, and this is one of the most important pieces, that they don't have to report on all of their they don't even have to report on all of their securities, and this makes it much more incentivized for them to hide their positions, of which specifically their short positions we need to know more about as people participating in the market. So democratize that data. I promised that we would cover what is a repo market briefly, so we will. This is Jerome Powell speaking on September 18th, right? It looks a lot like when he spoke back in March as well. On March 17th, amid the market turbulence caused by the coronavirus pandemic, the Fed introduced the Primary Dealer Credit Facility, or PDCF. The Fed had first created the facility during the 2007-2008 financial crisis to alleviate severe strains in the repo market. While mostly invisible to the public at large, the repo market plays an important role in the transmission of monetary policy. It is also a critical source of financing for non-bank financial firms, including securities brokerage houses and real estate investment trusts that specialize in mortgages. It is one of the organizations created, and it's important for us to be able to understand exactly what a repurchase agreement is. At the end of 2019, financial firms relied on the repo markets for over $4 trillion in borrowed funds to support their activities. So trillion with a T. This is why this is so important for the liquidity of the global markets. We had Adobit explain it like a pawn shop, right? Sometimes you need money, but sometimes instead of having money, all you have is stuff. So you go to the pawn shop, you drop off some of your stuff, and then you take cash that you'll have to repay later, and your stuff is collateral. The repo market has shown signs of strain even before the onset of the pandemic, but these difficulties appear to have been rather technical in nature and unrelated to fears of imminent recession. On September 17, 2019, repo market interest rates spiked dramatically higher. This precipitated a great deal of concern and discussion among market participants and policymakers. Initial explanations for the rate spike focused on U.S. Treasury financing operations in the aftermath of a period in which the Fed had substantially contracted the reserves of the banking system. But the discussion soon gravitated toward the roles played by some of the major policy changes that had been implemented in response to the financial crisis. These included changes in the Fed's monetary policy, operating framework, and changes in bank regulatory and supervisory policies, especially in the area of bank liquidity management. Taking a long-term perspective, it is hardly surprising that the functioning of the repo markets changed in response to the financial crisis. Throughout the post-World War II period, repo markets have repeatedly adapted to changing circumstances. So, as a reminder, this is not a new thing, right? This repo markets have existed for a while, but it is just a brand new device, the vehicle, like the mortgage-backed securities, that the hedge funds that don't care who they hurt, who at the end of the day are going to take advantage of. Market evolved, so let's just briefly go through this, right? The U.S. repo market has been changing a good amount. The repo market grew in the early 1980s. The series of bankruptcy highlighted the number of legal and structural problems. Most notably, let's find out what kind of problems there are. There was a widespread presumption that their repos were unlike other collateralized loans in one crucial respect. They were thought by many to be exempt from the bankruptcy code's automatic stay provision. This was a technical assumption that made a big difference because an exemption from the automatic stay provision would imply that the repo collateral would not become tied up in bankruptcy proceedings of indeterminate length, and that repo lenders would be able to sell collateral immediately in the event of a default. Okay, a little bit of confusion there. The courts ultimately decided. This is talking about Lion Capital Group. Very interesting, because Lion Capital Group is actually no, I'm thinking of a different group in the 2000s. Financial crisis here in 2004, 2007. So this actually played a big role in the financial crisis in 2008. In just 4 years between December 2003 and 2007, asset to equity ratio of U.S. broker-dealers ballooned from 24-1 to 35-1, and this balance sheet expansion relied heavily on repo borrowing. What's going on, Dr. Certifiable? Thanks for joining us at Mo Monkey. Lehman Brothers in particular relied heavily on the tri-party repo market to finance its securities inventory. Although Lehman continued to present itself as solvent in its quarterly financial reports, market observers became increasingly skeptical, right? This is where the Lehman Brothers were putting down their mortgage-backed securities and saying that this was an asset, whereas it was actually a liability. The firm finally became... Oh, here. This is the sentence right here. It was, in addition to questionable asset valuation methods, it was later discovered the firm had misrepresented its leverage by improperly pushing certain repo liabilities off its balance sheet at the end of 2007 and early 2008. So it's not only the brand new mortgage-backed security. It was used, repo agreements were used all the way back in 2008 to screw over the economy before. So as a reminder, this is something that was broken in 2008 and still, even though there might be some reforms coming out of the woodwork, not enough is being done, according to Alexis Goldstein. So I'm going to scroll down and see if this is going to be more changes. Yeah, I'm going to not only link this in the description so you guys can read more about it later, but I'm also going to link the AMA so you guys can crawl through it yourself if you guys still have any questions about what she wants to cover. Most importantly, guys, this is a channel where we might actually have Alexis Goldstein on in the future, and I'm crossing my fingers, excited for that. If you guys wanted to support her, she works with a subscription-based newsletter, and I will include the how to sign up for that down below. And finally, if you guys have not yet quite hit that like button, that's okay, it's understandable. Make sure that you do so that other Moon Platoon members can find out about this video. And if you guys want to support the video, this is a good way to join the Moon Platoon, Gorillionaire, or the Meatball the Space Legend tiers by pressing that join button next to the subscribe button. All of these people have done it or have gone down to Patreon, which is also a great way to support the show. And once again, thank you guys for joining us on this beautiful, beautiful Good Friday, and we'll see you in the money.